A dire situation is currently unfolding within the US banking sector, as recent data reveals that similar distortions to those preceding the Lehman Brothers collapse in 2008 and the failures of 4 major US banks earlier this year are now affecting hundreds of financial institutions. What you're about to discover in this video could change the way you think about your finances forever. Stick around to the end to get the full picture. This crisis has far-reaching implications, impacting personal finances, thousands of US businesses, and posing a serious threat to the overall economy and financial markets. The shockwaves sent through the financial industry by the collapses of Silicon Valley Bank, Signature Bank, First Republic Bank, and Silvergate in the first half of 2023 have created widespread instability, speculation, and fear. A key factor contributing to these bank failures was the rapid rise in interest rates, initiated by the Federal Reserve's aggressive efforts to combat inflation. Virtually all financial institutions felt the repercussions, as higher rates affected their loan portfolios, treasury and bond holdings, and funding costs, resulting in substantial losses. Make sure to subscribe to the channel and leave us a like below this video. While the pace of rate hikes have been gradual in recent months, the sudden shift, marked by 11 consecutive rate increases, took the Fed funds rate from 0% to 0.25% on March 16, 2022, to 5.25% to 5.5% on July 27 of the same year. This pattern closely resembles the U-shaped movement observed just before the global financial crisis of 2007 to 2009. In essence, raising interest rates diminishes the value of banks' assets while increasing their borrowing costs, limiting profitability, and leaving them more vulnerable to adverse events. Since the beginning of 2023, US banks have been grappling with sluggish loan growth and high deposit costs. The latter resulted from elevated withdrawal rates as customers withdrew funds from banks and sought higher-yielding investments, including money market funds. Consequently, banks were compelled to borrow more money from the Federal Reserve at significantly higher rates than ever before. This became a primary catalyst for the banking collapses witnessed during the spring. The rate hikes destabilized banks at a time when the value of debt on their balance sheets had also plummeted significantly. This prompted customers at other banks to follow suit and withdraw their deposits, fearing the safety of their funds. Shortly after the collapse of Silicon Valley Bank, millions of depositors rushed to transfer their money to regional banks and seek safer, higher-yielding investments. This mass movement saw approximately $120 billion in deposits, leaving smaller banks in the week ending March 15th, with a total reduction of $5.46 trillion in US bank deposits from June 2022 to June 2023. This 4% decline is the most significant decrease since 2008. Rating agencies have added additional pressure on banks by downgrading US government debt. In August, Fitch highlighted concerns about deteriorating public finances over the next 3 years and ongoing debates around the debt ceiling, which is the maximum amount the government can borrow. Sovereign downgrades often signal wider economic issues, placing banks in a more precarious position as they appear less creditworthy, potentially leading to downgrades in their credit ratings. This makes it more challenging for them to secure funding from markets and the Federal Reserve, reducing their lending capacity and affecting their ability to cope with bad debts, overall profitability, and share prices. This sequence of events closely mirrors the circumstances leading up to the collapse of Lehman Brothers in 2008. Just a couple of years prior to its downfall, the bank was highly leveraged in financial markets due to rapid growth and looser regulations. However, it lacked liquidity and adequate collateral to secure enough funding from the Fed or renew repurchase agreement contracts, repos, to prevent its collapse. Lehman took advantage of a regulatory loophole, engaged in risky asset maneuvers, and presented their financial statements in a misleading manner. This strategy allowed the bank to conceal its significant leverage during reporting periods and to regain the trust of investors, regulators, and rating agencies. However, this deceptive practice, along with excessive reliance on repurchase agreements, repos, eventually eroded confidence in the bank's financial stability. Market sentiment regarding Lehman's financial soundness began to deteriorate, leading to multiple credit rating agency downgrades and a substantial increase in its default risk, particularly around mid-2007. On September 15, 2008, the credit default swap spread for Lehman Brothers reached a staggering 1,450 basis points, triggering the largest bank failure in United States history up to that point. Similar conditions are still echoing in the banking sector 15 years later, evoking uncomfortable memories of the global financial crisis. The risk of widespread bank failures is currently higher than at any other time. Consequently, Wall Street analysts are once again pointing the finger at regulators. In a recent analysis published on Parade.com, financial experts Pam and Russ Martin revealed that U.S. regulators and the central bank have been withholding critical information about the true financial condition of several large financial institutions for over a year and a half. They did so not to alarm the public and prevent further bank runs and failures. The Martins discovered that on March 30, 2022, the Federal Reserve reported that unrealized losses on available-for-sale securities at the 25 largest U.S. banks were nearing the same levels they had reached during the 2008 financial crisis. Curiously, on that very same day, the central bank ceased reporting data about the bank's unrealized gains and losses on securities. As shown in the chart, the Federal Reserve had been reporting this data series from October 2, 1996 to March 30, 2022. And then it abruptly disappeared. This data cannot be found on the Street Louis Fed's economic data website. It's difficult to dismiss the timing of this data series being halted shortly after the Federal Reserve began raising interest rates on March 17, 2022. This exacerbated the situation for U.S. banks, as they had heavily invested in low-interest rate Treasury securities and Federal Agency mortgage-backed securities, MBS. They did so because their deposit balances had surged to historic levels due to trillions of dollars in stimulus payments directly deposited into depositor accounts at banks during the pandemic. The pandemic had led to mass business closures, negatively affecting business loan demand and prompting banks to turn to government bonds as a safe place to park the surplus deposits. In hindsight, parking such large sums of a bank's deposits in bonds with extremely low yields was not a rational long-term strategy. As noted by analysts, several banks failed to hedge against the interest rate risk associated with these bonds, meaning they were unprepared for a scenario in which interest rates would rapidly rise. In fact, data shared by Martin reveals that 75% of US banks did not hedge against interest rate risk for 2022. The lack of effective risk management resulted in $516 billion in unrealized losses by the end of the first quarter of that year. As interest rates rose, the market value of bonds with lower fixed interest rates declined because they paid less interest than newer bonds with higher fixed rates, making them less attractive to investors. Just a few months ago, Jamie Dimon, the CEO of J.P. Morgan, criticized government rules that incentivized banks to accumulate large portfolios of U.S. Treasury bonds. These bonds lost significant value as interest rates increased, resulting in paper losses for lenders and leaving investors unimpressed. Bonds have an inverse relationship with interest rates, a fundamental principle understood by every trader on a bond trading desk. Thus, it raises questions about why banks thought they could forego the cost of hedging this massive risk. Prompted by this inquiry, the analysts investigated what banks might be concealing from the public. According to their study, many institutions, including Citigroup, have been engaged in a shell game, moving securities around to disguise ongoing losses. A practice that most Americans, especially those with federally insured banks backstopped by the US taxpayer, would certainly disapprove of. This mirrors precisely what Lehman did before its collapse, relying on a highly controversial accounting rule known as held to maturity, or HTM. Debt instruments are not being marked to market or shown on banks' balance sheets at their fair market value. Instead, they are listed at amortized cost, which reflects the amount paid for the debt instrument at the time of purchase, regardless of its current market value, which could be significantly lower, possibly 20% or 30% less or even more. This accounting rule allows banks to create an illusion on their balance sheets, making their assets appear more valuable than they actually are. The larger the dollar amounts held as held to maturity, HTM, investment securities, the more significant this illusion becomes, as noted by analysts. Even J.P. Morgan, the largest financial institution in the country, has moved massive amounts of securities into the held-to-maturity category. According to the bank's report for the quarter ending December 31, 2022, it was holding $25.3 billion in HTM securities, which actually have a fair market value of just $388.13 billion. The issue is that most of these debt instruments were not initially designated as HTM at the time of purchase, but were transferred to that category in 2020, 2021, and 2022, suggesting that the bank is using this maneuver to bolster its capital. To assess the true extent of these unrealized losses across the banking system, investors and depositors have to rely on the FDIC's quarterly banking profile instead of being able to access the information more regularly. Unfortunately, a lot can happen in the span of 3 months, as Americans witnessed between April and May when the second, third, and fourth largest bank failures occurred. As of June 30, 2023, according to the FDIC, unrealized losses on securities amounted to $558.4 billion in the second quarter, an increase of $42.9 billion or 88.3% from the previous quarter. Unrealized losses on held-to-maturity securities totaled $9.6 billion in the second quarter, while unrealized losses on available-for-sale securities totaled $48.9 billion. Adding to concerns about the 25 largest banks in the nation, deposits have decreased by $920 billion since April 13, 2022. In other words, the US banking system remains vulnerable to both financial shocks and more general calamities. The failures of Lehman Brothers in 2008 and 4 other banks in 2013 were rooted in regulatory inadequacies and shortcomings in financial markets. These events serve as stark reminders of the critical importance of robust treasury and risk management practices. They underscore the need for diversification of funding sources to ensure bank stability in the face of market fluctuations. Currently, nearly 200 banks are at risk of facing the same fate as Silicon Valley Bank. If just 10 small and mid-sized banks fail in the coming months, it could trigger a cascade of failures that would impact larger banks as well. This, in turn, would lead to a major credit crunch, making it difficult for businesses and consumers to access credit. Already, a credit crisis is underway, with bank credit declining year over year and corporate and personal bankruptcies, as well as consumer debt delinquencies on the rise. Many Americans have reported a deterioration in their access to credit in 2023, and this situation is unlikely to improve soon. The legacy of financial instability and stress in the banking sector is expected to result in tighter credit conditions and more stringent lending standards. Ultimately, more bank failures could lead to bank runs on vulnerable financial institutions, damaging confidence in the banking system and causing widespread panic. When lending tightens, it negatively affects the value of stocks, real estate, and other assets and hampers overall demand, potentially leading to a disastrous recession and the most significant financial crisis in recent memory, as experts have been warning.